All right, good morning and welcome to another edition of the weekly market note here at Main Management. As usual, I'm Alex Varner, head of research, alongside
James Maxwell, VP of Research.
looking through the performance for the trailing week. Pretty much green, blue across the board and positive. A lot of that was driven by Friday's action where markets responded positively to Chairman Powell's speech in Jackson Hole. A lot of that was basically because they kind of interpreted it as more dovish.
Yep.
The minutes, we discuss this in a couple of minutes, but the minutes came out earlier this week. But in the meantime, year to date and trailing week, things are kind of, largely positive. For the week, the two negatives are communication services and tech. And then healthcare had a pretty solid 1-4. No, not quite as good, but it's kind of had a broadening out of the market. You see small caps on the left were up 3-4.
Yeah.
That led there. So you're seeing kind of a little bit of a broadening in the market, which is nice.
After kind of tech and comm services and those kind of growth technology-esque sectors have led most of the year. I think last week was a bit of broadening out, some pulling back in some of the winners and going into some of the losers so far year to date, like the small cap.
Yeah. Recession dashboard, kind of consistent as it's been for August, steady as she goes, like the Fed, data dependent. So kind of waiting and see if anything starts to really kind of break here. On the FOMC minutes, so the two charts at the bottom are the kind of price action on the right of the S&P 500. You saw pretty early on in the morning, things shot up on Powell's speech, and on the left, yields conversely dropped. And what that basically says is markets are pricing in a cut in September, or starting to get closer to pricing in one of those. The probabilities have shifted in favor of that. The minutes that came out were arguably a bit stale, given that they're from the prior month.
Yep.
And since then, we've got PPI and CPI data, week payrolls numbers. So those were kind of maybe a little bit more hawkish because they came out prior to the data we just mentioned. And then the speech clearly incorporated the data we've gotten since then and was a little bit more dovish. And I think they were kind of pointing to that week payrolls.
Yeah, I think that was a huge part of it was that payrolls.
Which is interesting because the minutes were like, hey, we're kind of focusing on inflation, which inflation you don't have rate cuts to combat high inflation. You raise rates to combat inflation. But I think they're hoping that things will, if not continue lower, at least trend sideways, which will give them a little bit of room. The hard part is with the payrolls, now you are seeing a kind of a larger change in the break-even number with the immigration issues, or I guess the kind of almost exclusion of immigration numbers. And so break-even has gone from previously it was 80 to 100,000 a month.
Yeah, or even higher.
Yeah, and some people are now saying break even could be as low as like 25,000 to 40,000. So you are seeing this, adaptation or adjustment of expectations around what is going on with the actual break-even employment numbers. We do get another employment report, not this week, but the following week, the week after Labor Day. So we'll see there how things go. And we get another inflation report, in September as well, but that's still a couple weeks out. But again, markets are now kind of leaning towards one cut in September. But I don't envy the Fed here.
Yeah.
with where they stand and what the data's been saying.
Yeah, on the payrolls report, obviously we've talked about it previously, but I think that was such a big turning point for the Fed, especially because they were using that, I think, as the last straw almost to say, well, like the labor market's fine, so we're not that worried, we're not that worried. And then you had this big revision and kind of full report. It was like, oh, it's actually not as good as we thought. So let's kind of recalibrate our in this case, our interest rate policy.
Yeah. Yeah. So we'll wait and see, but they've certainly got a lot of discussion and debate coming up. You've already seen dissension among the ranks with a couple of dissents. They were the first in, a couple decades based on the voting numbers, and you can kind of slice those numbers to make it seem more dramatic or less dramatic, depending on how you want to define things. But regardless, there's definitely discussion and debate within the FOMC on the correct or the best path. I think correct is not a great term to use here. Best. For the macro data this week, we got existing home sales. This is a pretty light week on the macro side, so this won't be a hugely in-depth thing. But existing sales kind of came in above forecasts, which is good. They're up 0.8% year over year. Inventories are now at their kind of highest level in quite a while. They're up 15% year over year. Again, this market continues to be stymied by high prices and high rates. and it's just hard for, buyers to step in.
There was an interesting article, this has been discussed, but the piece I was reading was in The Economist. It was talking about how this AI boom has kind of dwarfed the economy, and especially like they're putting it in relative to mortgage rates, where these build outs of data centers and kind of that huge amount of money flowing into these build outs of these data centers was keeping interest rates kind of, I wouldn't say artificially, but just higher than they would be otherwise, making it harder for, average residents or, average people to have those lower mortgage rates, because they're kind of being boosted by this other part of the economy that isn't.
It's price insensitive in a way. Yeah. And I think we've seen as well that the spread between the 30-year mortgage rate and was it the 10-year treasury is extended. It's 100 bips or 75 bips higher than it normally has been, which to James's point is that is kind of this artificial or, maybe not historically normal price delta between the two rates. So we'll see if that starts to come down. It certainly will be helped if the Fed starts cutting rates. Mortgage rates will respond in kind. But again, you're kind of stuck with this housing market. And you can see even as it ticked up, it's still at levels that are comparable to the depths of the housing crisis, which is kind of hard to believe in what is, kind of perceived as a pretty solid economy. On prices and supply, prices, no surprise here. They're pretty cyclical on the left there. That blue line is definitely just kind of chopping higher. At least the kind of rate of change has started to slow. The year over year, they're up just 0.2%. That's the smallest since June of 2023. So you are seeing some kind of relative comparison of smaller growth or lower growth on the pricing side. And again, similar on the right there, because house prices are still high, houses are just sitting on the market a little bit longer. And it's now back up to the highest since July of 2016, right back on the median at 4.6 months. And for those of you unfamiliar, that's basically just if you assume a current sales rate continues, that's how long it would take the market to clear. So 4.5 months of inventory on the market. We got housing starts as well. Total housing starts jumped above forecasts for a decline. Good to see there. Single family starts ticked up to 939,000, while multifamily starts are really the big driver of that headline number, and that's their fastest rate since May of 23. They're all positive year over year, accelerating, which is multifamily's not, but that's far more kind of volatile. But nonetheless, it's, again, you got to start somewhere, and you hope that these will kind of start to grind higher. Historically, they're not, super low or super high. They're kind of middle of the road. Most of them are right near above their median. So nothing hugely out of sort here, but it would be nice to see these kind of start to move a little bit higher. On the building permits as well, and you think about the process, it's permits, and then you get a permit, then you start building a house, then it becomes a new home, then it becomes an existing home. But the permits, missed expectations, fell to 1.35 million units seasonally adjusted annual rate. That's the lowest rate since June of 2020. So you're seeing some softness here. And the concern is that if you're getting softness in permits, then that's fewer permits to build homes. So you might see those starts start to roll back over. But we'll see. But, all three of those total, multi, and single family permitting categories are decelerating and are negative on a year over year basis. So not great here. But again, this is kind of the housing market is just in a tough spot. Not much else to say about that. I think this is one of the last data points we have here is the flash PMIs. These are the purchasing manufacturer indexes. On the manufacturing side left, we saw some solid improvements pretty much across the board. The U.S. was well above forecast for 49.5 and hit its highest since May of 2022, rising at 53.3. Germany was up. France was up. These are hitting kind of multi-year highs, which is good. Germany and France are still in contraction, but you got to start moving up somewhere, and they're at 49.9. So essentially, it's a break even. UK ticked down. Euro area is up, best since June of 22. Australia's best since September of 22. India's its best since 2009, which is kind of wild. And on the right there, the services were more mixed in. India showing remarkable strength relative to the other kind of flash indices. The U.S. ticked down to 55.4, but that was still above forecasts for a 54.2, solidly an expansion. Germany, Japan, Euro area were down. France was up. UK was up. Again, India's up and Australia ticked up. So kind of mixed reading on the service side. But again, things are generally seem to be trending higher, which is what you hope to see. It'd be great to get these, more more than less back above 50. But
yeah, you're starting to come out of that contraction that you've had over the past couple of years, especially in the European area.
Yeah. And that's kind of the macro data for the week, honestly. I mean, we go into the summary here, but again, the minutes in Powell's speech, data dependent, markets are leaning towards a 25 basis point cut in September. We'll see if that materializes. The housing market, we saw existing home sales, starts, and permits all kind of muddling along, some a little bit better than expected, some a little bit worse, but just kind of on the housing market.
If you look kind of from the top down, it's overall just kind of a pretty bleak picture on the housing market.
And then flash PMIs, better on manufacturing and a little bit more mixed on services. But the U.S., back in solid expansion territory, multi-year highs for the manufacturing figure, and the services is still at 55, so above 50. So that's good to see here. At least things kind of, from that standpoint, plowing right along. This week, we get new home sales, we get durable goods orders, second estimate of Q2 GDP, and then probably the biggest data point is the core PCE. That's the Fed's preferred inflation measure, so they will definitely be watching that.
Yeah.
I think people have been putting out forecasts because once you get the CPI and the PPI, you have the components or most of the components, and it's just a matter of kind of getting the weightings. But they're looking for, I think, like 0.3.
Yeah, that's kind of what I've seen
month over month.
Yeah.
So we'll see if that comes in. But you also get incomes and consumer spending, and that consumer spending number will also be closely watched to see, are people continuing to buy things?
Yep.
Because it's hard to bet against the American consumer.
Yeah.
So we shall see. But that kind of wraps it up for this week. Thanks for joining us, and we'll talk to you soon.
All right. Thank you.